Going to update a couple markets tonight. The first thing I'm going to look at is the stock indexes tonight. Kind of an interesting day today, interesting position in the markets. And what we saw is there was some news on a Greek bailout package this morning, which obviously has been anticipated for weeks or months there. Now, from a contrarian standpoint, oftentimes when the news comes out like that, what is seemingly good news that we finally got some resolution to this, or we've got the issue resolved, and you'd think that now the markets are safe, the markets will rally in anticipation of that, and then as the news comes out, they'll top and turn down. We saw a similar thing that happened back here in July when we had this debt ceiling issue with our government basically being bankrupt, and in order to continue operations they had to raise the debt limit. And that's obviously been known for, we could argue, for years and years that would happen. It would come to a point there. And what we saw is in the weeks preceding that announcement, which the deadline was right around this area here, the markets put in a decent rally leading up to that. And then as the news came out somewhere right around here, the market really accelerated and sold off. And we're right back up to, not surprisingly, that level right now as far as the this chart is at New York Stock Exchange. So we may be able to view that news on that bailout there as possibly a topping sign. Now, I'm not going to use that to make trading decisions, but that's just an interesting way to look at these here. Here's what's going on technically with the market. Is we've had a high there on February 9th. We had a small consolidation that, if you look at on a shorter term time frame, looks like a triangle pattern, like a A, B, C, D, E type of pattern. And we've had a move to new highs. So usually those triangular type of consolidations happens in the next to last wave position. So that doesn't necessarily mean this is a major top, but at least there may be a correction of this move up here that we would expect to come down and break that support level and at least test the lower wedge line here. So we probably should expect that possibly with another rally up here, although that may not happen, and I'll go into some reasons shortly here of why that might not happen. What you also see is this is the RSI down here, standard 14 period RSI, and at that corresponding high on the 9th, the RSI was peaked out here at around the 74 level. It dipped on the consolidation. Now it's only risen back up to the 68 level despite a new price high. So we have a pretty sharp bearish divergence on the RSI relative to price. If you've ever studied any type of technical analysis, that's a perfect looking textbook divergence there. It was above the overbought line, above the 70 line, dipped down below it, and now is rallying back near to it. There's also an RSI trend line there, which oftentimes that trend line will break prior to the actual price break. So this trend line in the RSI may get broken by the RSI here prior to the price breaking down, and I think that's reasonable. We'll probably only take 1 to 2 down days to break that trend line. And after a divergence in the RSI with price, one way to use the RSI and use it intensively for trading purposes is to short the market as soon as the corresponding RSI trend line is broken. So let's say the market declines for a couple of days here, and that RSI comes down below that red trend line. You could short the market with a stop up above there, expecting at least a sharp, relatively short-term decline, or potentially an intermediate type of term decline. Now, as far as the pattern here, I really like this pattern. The pattern that I studied the most in my life is called the Gartley pattern, and specifically it's sometimes called the Gartley 222 pattern, because in the original works of the author whose the pattern is named after, on page 222 of his book, he delineated some different types of Gartley patterns with different ratios. And specifically, the ideal Gartley pattern is where you have, let's say in this case, a decline. you would have an ABC correction with the A coming to the 61.8% retracement, and then a B wave, and then the C ending at the 78.6% retracement. Now, ideally, the price will also peak near the 127.2% what's called external retracement of the B wave here. So that's what this blue line represents, and we're right at that today. So between this light blue line and that dark blue line is the ideal Gartley pattern potential reversal zone. In harmonic pattern terms, that is the ideal zone there. What we also saw today is we have a picture perfect doji candlestick. So the market had a very tight open and close range. In fact, it was about 0.63 points between open and close versus a 55 point range in the market. So it was a small range day, and it was a very tight close similar to that day here. And we had that with technical divergence. So in addition, we had it on a news event, a high profile news event. So this may be a very, very significant candlestick right there. I would say there's a reasonable chance that this may be a major high in the market. I don't really have any confirmation of that yet. What we'd want to see to have any indication that that is true is we would want, at the very least, the market to come down below this level here in 2 days to have an initial confirmation that the downward momentum price action is now faster than this prior upward price action. That would at least confirm a short-term downtrend, but given the technical setup here and all the other information I've gone over, it could be an intermediate high as well. I wanted to show a couple things on the NASDAQ as well. This is the QQQ, so NASDAQ 100 ETF. We had that nice bearish engulfing pattern this past Wednesday when Apple sold off real hard. Now the market has come back, and basically, let's look at the highs here. 63.86 that Wednesday. We got up to 63.89, so we just barely clipped that high, but then closed below it. There is a very nice divergence on the RSI as well, relative to price, relative to that February 9th high. So this could be a topping zone in the QQQ. Now, what I want to do is click over and show you a chart of the VIXN, or the NASDAQ 100 Volatility Index. Now, what this is showing here is the NASDAQ 100 ETF, QQQ, up here as a line price chart. So that's the price of the actual NASDAQ 100, the chart we just looked at, but in a line chart. And then this down here is what people call the VIXN. It would be corresponding to the VIX, which would be for the S&P 100, and this is the NASDAQ 100. So what the VIX is a volatility index. It's a measure of implied volatility in the options on the underlying index, so the options trading on the NASDAQ 100 stocks. And what is a very common pattern at market highs, I'm going to go over here, is you see they trade inversely to each other. So the lower the volatility, the more complacency, the less expectation of declines, and in contrary fashion, you see low volatility when people should actually be expecting volatility and trading for that. So you use this in a contrary fashion. So low volatility is going to correspond with market highs. So low volatility, market highs, low volatility, market highs. And what happens here pretty consistently at the tops is you see the ultimate low in the VIXN, which I have represented at rally highs. The low in the VIX is represented by these vertical blue lines. And so it makes a low, the VIXN rallies, and then it comes to a higher low. So price is making a higher high, but there's this divergence or non-confirmation in the volatility index. We saw that happen April 2010. Market went on for a week or so after the low in the volatility. We saw that major correction, 17% or so, from April to July 1st of 2010 there. We saw as the bull market neared the high in 2011 is a peak or a trough in volatility in January. The market pushed to a higher high in February, but the volatility index was higher. And again, we saw a sharp sell-off into March. Then right at the peak in second half of April, we saw the low in the volatility index. Price pushed higher for a week or so, and there was actually a higher bottom in the Vixen right at the peak on May 2nd there. Saw the same thing happen again right prior to that debt ceiling issue, where you had the volatility index low at the beginning of July, and then it shot up significantly and came to a higher low towards the end of July, even though price made a higher high. And then we saw that dramatic decline from July to August there, and we're positioned in a nearly identical fashion to that one right there. The slope or the divergence in the underlying volatility index relative to price is a very sharp upward divergence there. It's basically the same angle as that one there, corresponding to the July price peak. So what we saw in those instances was slight consolidation after the high, initial day or two down, a slight consolidation, day or two down, slight consolidation before further decline. Here we saw some slight consolidation before further decline. Here basically marked the peak before the bottom fell out of it. So by this measure, whatever high we're seeing here, this non-confirmation or divergence in the underlying volatility index may indicate that this will be a significant rally high, due for a sharp correction on the order of probably at least 5 to 6%, potentially significantly more than that. I've already gone over some of the longer term patterns here. I've already gone over the fact there's been a major commitment of traders, smart money, sell signal at these levels, so everything would indicate that we're zeroing in on a major high here. This could be it. I don't know if this is it. I would lean towards that happening relatively soon here, though. This is the Russell, and since I've been looking to trade this one, I want to go over the setup here. The stochastics has crossed up into a buy signal on the last couple of days. Price has basically more or less equaled the prior highs yesterday in the Russell, but now there's this sharp divergence in the stochastic relative to price there. And the way I'm going to go about trading this is if the basically if the market comes down and takes out that low there, that's going to be an indication that at least this wave up is complete, and we should probably see a retest of the lower channel line there, or wedge line. So if you enter on a break of that low there, and then the market touches here, you could potentially set a stop to break even. But the strategy I would use is just keep the stop above here, let the market do whatever retesting it has to do, and give it a chance to break down. If I do get stopped out and the market comes here and then comes higher, I would look to enter again when it gets up there, assuming the signals give a nice re-entry at some point there. So that's the setup here on the Russell, and I'm looking to short this market at a break of that low right there. This is the S&P 500. The S&P 500 traded within, let's see, we were at 1367 today. The May 2nd high was 1370. So we got within about 3 S&P points today of clipping that high, which ideally we could have seen to create a double top or failed breakout type of situation there. The nearest futures did exceed that high. So sometimes you'll hit a situation where the nearest futures will break the corresponding high, but the cash won't. That might happen here, although I would like to see the cash actually break that high. I don't know what we'll get tomorrow, but similar to the Russell here, there's a slight bearish divergence between price and the stochastics here, and we're right near that old high. So here's what these pink lines represent here, which is what I wanted to show on this chart. These 3 lines represent what I believe to be the most likely corresponding rates of decline of what we should see once this upward pattern, once the high is actually in and the pattern is complete. I'm not really saying that's happening here, though. I think that probably is happening here. We don't really have any confirmation of that yet, but here's what those represent. Those represent the decline here from basically this July to August decline. And then it also represents this decline from April into May, May or June of 2010, and then it also corresponds to the, if I click over to a weekly chart, this decline here in January of 2008, which was basically the initial, here's where I view the pattern as ending in that bull market, with kind of a contraction here, and then the market broke out. So those three lines correspond to this move down, this move down, and this move down in the market. So when an upward pattern ends, those are actually the three most recent similar corrections to what we should see happen here. Now those are pretty big. Those are pretty aggressive declines, but that is what would logically need to happen to indicate that a correction of a similar degree is actually occurring relative to that. So let's assume today was a high, though I don't know that it is, you'd be looking at by the turn of spring, by third week of March, the S&P being below 1165 there. And then the implication is, with this high, once the pattern is complete, this whole move up from October should be completely retraced in less time than it took to form. So we're getting close to 5 months now. So by this summer, we should definitely be lower than that. If and when this pattern completes, I think it'll actually retrace a lot faster than that. So that's basically all in the what I wanted to go over on the stock indexes. I did want to touch on gold because that's an important area too. This is the GLD ETF, and what we had here is basically on, if you look at, I'll click over to the hourly chart, there was a triangular type of consolidation down to the 20-day moving average over the last week or so. We saw the Greek bailout news today. We had this gap up in gold out of that triangle. Again, these type of triangle patterns often form in the next to last position, so we may assume from this contracting triangle that this move will be the final move on this rally. On the daily chart, I already talked about this setup recently. The Bollinger Bands are squeezed, and this upper one is starting to channel horizontally now. What would be ideal is to see a spike of that upper band, a break of this high here, which basically the market is right at that high today, and then a reversal lower, a close back below those highs, and then see one of maybe a few signals, whatever you use your technical indicators, but the stochastics to turn down into a sell signal, the hourly MACD to turn down into a sell signal, or a bearish candlestick like a shooting star, a bearish engulfing pattern forming right up here at the upper Bollinger Band line. We're also right under this bull market trend line, so we're retesting that from the underside. This is just a really nice setup here, and I wanted to touch on one more thing that I've actually a couple more things that I've went over before. First off, the ideal for let me move this out of the way and then redraw that in a minute. The ideal for this would be this is now the the nearest futures in gold. So we would actually want to see ideally the nearest futures price come up and break this high right here. Let's say 1767 on gold. We closed the day around 1758. So to see that slightly exceeded and then the market to reverse and close below those highs, and then you can enter short as soon as you get a technical sell signal with a stop above that high there. So that's really the setup here. The thing I just erased is showing that the time from the November high to the December low, we've now equaled that amount of time up from the December low. And we have yet to break, we didn't break that November high. So from a price logic standpoint, the downward move was still stronger than the upward move. So this move did not completely retrace that move in less time than it took to form. As of today, we've equaled that time and it didn't break that high. So this indicates that the price trend, the underlying psychology, the power of the market is still in a downward direction. There was a minor COT sell signal a couple weeks ago. The cycles, the technical indicators, the shorter term patterns, everything is indicating here that we're probably within, maybe even tomorrow with gold topping on this advance. So be looking for that here. The markets I'm looking to really trade or go short on are gold, our oil, and our stocks. Also, you could add the euro to that, or go along the US dollar, some type of bullish US dollar ETF there. But that's the setup on gold. There's a similar setup in play on silver there. The implication is absolutely that gold should go down and break the lows from this winter. How fast will that happen? I would say it should likely happen in less time than this advance took to form. So we're going on 2 months on that now. So by the end of April, we should see gold likely down below that 1500 level, maybe well below that, because once that low gets broken, we may see a very fast waterfall type of decline there that I briefly talked about. So that's really all I wanted to go over on this update. I think we're very, 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 very close to a major high here. We may be seeing that today. I don't know, but just keep a lookout on this. I do like to I've studied reversals in the markets a lot. I like to trade reversals because by definition, right when a market is changing trend, you're going to get the biggest reward relative to the risk at that time frame. So if you can catch within a day or two of the high here, you could potentially be looking at 10 and 15 and 20 to 1 reward to risk potential on these type of trades. Now, you need to have a trailing stop mechanism or some specific projections, and then use your technical indicators of when to actually take that profit. But I like those type of trades. I know there's risk of getting stopped out when you could place a wider stop, and probably the market will prove the analysis correct in the long run. But I like the very high reward to risk trades there, and that's what I'm going for. Really am looking for in the markets right now. So that's all for tonight's update. Have a great night.